When I first got into investing, I thought that dividend yielding companies were the holy grail of the stock market, always giving you a guaranteed return without you having to do anything. And when you hear that some companies will give you a dividend payout of 8% and a bank won't even give you 0.5%, it almost sounds too good to be true. However, it can be a very risky strategy, and it all depends on which companies you choose to invest in. So in this video, I'll be showing you the best dividend yielding companies, how to actually buy them using a brokerage platform, and the best strategy to help maximize your profits with this investing strategy. Firstly, what is a dividend? Essentially, it's just the distribution of a company's profits back to its shareholders in the form of a dividend payout, which is expressed normally as a percentage and is readily available on the majority of brokerage platforms and can also be found from doing a quick Google search of a business. It'll show you if it offers a dividend and the percentage that it's going to pay back to you as well. So why do companies offer a dividend? Normally ones that are quite mature and have been around for a long time are the most consistent at offering a dividend to its shareholders. They don't really have a better place to put their money because they're already mature and developed, and they're not really in the early phases of growth anymore where they have to use a lot of their own money to grow the business. Instead, they share some of it, albeit a small percentage, with its investors in a form of a dividend payout. This also draws new investors to the company because they know a dividend is a guaranteed way for them to make money, and can also increase investor confidence because only stable companies that have been around for a long period of time can really afford to consistently pay out a dividend to its shareholders. Some of the biggest companies that consistently pay out a dividend are ExxonMobil, Apple, and Microsoft. On the other end of the spectrum, companies that are fast growing and are still in the early phases of development typically don't choose to pay out a dividend. Management believes that it's better to reinvest the money into the company to further its growth and strengthen its operations. On the other end of the spectrum, companies that are expanding quickly typically won't make a dividend payment because the management believes that it's better to reinvest the company's money in order to grow it and expand its operations. Realistically, investors can make money here as well, but only when they sell their stock for capital gain once it's appreciated in value. Some of the most recognizable companies that don't pay a dividend are Amazon, Facebook, and Google. So jumping into some of the pros and cons of dividend investing. Starting with the pros, essentially it's one of the most true forms of passive income. All you have to do is just put your money into that company and wait for the money to roll around and hit your bank account once those dividend payments come out. And also, if you have a significant amount of your money allocated to dividend yielding companies, you'll also receive capital appreciation and a dividend payout. And this is the most true if you pick strong, well-rounded dividend yielding companies like those that we discussed earlier, including ExxonMobil and Coca-Cola. So you'll not only be getting money from the dividend payout, but also the share price of that company consistently increasing. It also greatly reduces the overall volatility of your portfolio. Because dividend yielding companies are far more established than growth based companies, they don't have very rapid price fluctuations, meaning that your overall portfolio is much more stable. And also you get excellent compound interest through dividend investing because of the stability of the companies and the consistent money that they pay out. And essentially compound interest is just where you earn interest on your interest. For example, if you had $10,000 invested at an average return of 10% per year over a 20-year period, that $10,000 would become $67,275. Keeping in mind that you always have to be reinvesting your profits to get results like this. Looking at the difference that reinvesting your dividends can make in the total value of your portfolio, I'll be looking at some research made by Market Sentiment, and I'll leave a link to his article down below in the description box. He took a look at the difference of reinvesting your dividends for a $10,000 sum in the S&P 500 from 1960 to 2021, and the final difference in your portfolio would be massive. If you had invested $10,000 in the S&P 500 in 1960, in 2021 your portfolio would be worth $795,000, which isn't a bad return by any means, sitting at 7,885%. However, if you had reinvested that money, your portfolio would be worth $4.94 million, and your total return would be $49,500 496%. So you can see how massive the difference can be versus reinvesting that money or just keeping it and pulling it out of your portfolio. So with dividend investing, it's always critical that you reinvest that money, and just because that money freely enters your account when you get your dividend payout, you shouldn't just withdraw it. It's best to reinvest it so that money can keep compounding and growing for you. Jumping into some of the cons of dividend investing, and firstly, it's not always guaranteed that the dividend will be paid out to you. It's always based on the profitability of the company, and if it's having a bad financial year or in some type of recession, then the dividend is not always guaranteed. Even very popular companies that are well structured and well established like Disney can also cut their dividends. In 2020, Disney actually cut its dividend for the first time in decades, so it goes to show that regardless of how strong and how profitable a company is, a dividend is not always guaranteed, and the current state of the economy and the stock market itself is always the most dictating factor that's going to determine if the dividend can actually be paid out. And also, dividend yielding companies, because they're very established, they don't grow as quickly, so you don't get very exciting gains if you're investing in businesses like Coca-Cola and McDonald's in comparison to growth stocks like Tesla, which can see massive increases in their price and can be far more appealing to new investors that don't want a slow and consistent strategy, and instead they prefer a risk versus reward strategy where they're happy to invest in a company that has a lot more volatility but has the potential to make them a lot of money in a short space of time. So what are some criteria that you should be looking at before investing into a company? Essentially, the main thing that you're looking at is the financial health of a business, because you don't want to be lured into a dividend trap, and this is when a company will offer a nice juicy dividend to lure in unsavvy investors who only look at the dividend payout but don't look at how well that actual company's share price is doing. Taking a look at AT&T, which has a nice dividend of 6.46%, which looks great on paper, but if you take a step back and look at how well that company's share price has been doing over the past 5 years, you will see that it's fallen 36%. So that means no matter how high that dividend is, you'll always be losing money. This means that if you had invested $10,000 into AT&T 5 years ago, your portfolio would be worth only $7,000, because essentially you would have lost 30% over that 5-year period, because the dividend payout is just over 6% and the company's share price has gone down 36%. So the difference between those two is 30%. So your $10,000 would have gone down to $7,000, and you would have actually lost $3,000 despite having that very high dividend payout. So it's not all about how much dividend you're getting, but about how well that company is doing, because a high dividend payout doesn't cancel out a falling share price. Instead, you're better off picking stable companies that offer a lower dividend but have consistently been growing in value over the years. Looking at something like Coca-Cola, who offers a dividend of 2.88%, but its share price has gone up 32% in the past 5 years, meaning that if you had invested $10,000 5 years ago, your portfolio would be worth $13,200, and that's not even including the extra dividend payout that you would have gotten as well. While on paper, Coca-Cola doesn't look as exciting as AT&T if you're looking at just the dividend, but in the long run, Coca-Cola is going to be a far better option because you'll actually be making money instead of losing money through AT&T. Remember, if you find the content helpful, make sure to drop a like for the YouTube algorithm. So what's actually going to be the process of buying shares of a dividend yielding company? Firstly, you'll need to create an account with a brokerage platform so you can actually buy some of these businesses. And the broker that's available varies depending on which country you're living in. So in America, there's Robinhood. In the UK, there's Webull. In Australia, there's Stake. In New Zealand, there's Hatch and Sharesies. So it all depends on which country you're living in, but the sign up process is very much the same regardless of which broker you're using. You will need all your personal information like your email address, phone number, and date of birth, and you also have to provide some proof of identity. Normally a driver's license or passport is enough. Once you send all that information through, it gets verified and then your account is created. So I'll just jump onto the New Zealand broker Hatch and show you all the steps needed to actually buy shares of a business. Even if you're not using Hatch and it's not available in your country, you can still follow this example just the same, since the layout of all these brokers is virtually the same regardless of which one you're using. So when you jump on Hatch, this is what the home screen will look like, and it'll be similar no matter which broker that you are using to buy your shares. So all you need to do is just go up to the search icon and type in the particular business that you're wanting to buy. So I'm just going to search up Coca-Cola, and you can see that it's the first result that pops up. All you need to do is click on it and then select which buying option that you're going to pick. Personally, I go with market buy order, which is just when you buy the shares of the company at the current market price. So at the moment, Coca-Cola is trading at $62 per share. I'll just type in the amount that I want to buy, and then I'll just hit review market buy order, and the shares will be purchased for me. So that's really all you need to do to actually buy shares of a company. It's a very straightforward process, and it's not much harder than just using internet banking. So finally, are dividend stocks just overhyped, or are they really as good as everyone makes them out to be? In my personal opinion, they're definitely not a bad addition to anyone's portfolio, but if you only invest in dividend yielding companies, you're shutting yourself off to other asset classes that can potentially make you far more money. You're ignoring things like cryptocurrency and growth stocks like Tesla that can give you a far greater return in a much shorter space of time. While these might sound risky on paper, there's always risk associated with anything, and especially that's true in the stock market. Even very established blue chip companies can see massive drops in their value. Taking a look at Facebook, which has recently fallen over 50%. Even some of the safest investments in the world, like investing in an ETF that tracks the S&P 500, which is just a collection of the top 500 biggest publicly traded companies in America, and essentially it's deemed to be an accurate representation of the overall stock market. Even the S&P 500 can fall over 30%, and it does this quite routinely. Roughly every 8 years we come into a recession, and the S&P 500 can see drops exceeding 30%. So there's always risk when it comes to the stock market, and it's important to understand the volatility that comes with investing and how to take advantage of it. Check out this video on screen so you can see how to profit in a recession and actually use it as a buying opportunity instead of something to be scared of where you think you have to sell all your money and cut your losses so you don't get burned. Taking advantage of a recession and thriving in it is key to being a good investor, so make sure to check out the video on screen to help you profit in the next recession.